Banks have ruled not just the economy, but the entire world since the dawn of time. They are the center point that make or break a nation and dictate its global power. So what happens when one of the largest banks of the largest nation suddenly crumbles?
The historic collapse of Silicon Valley Bank.
Collapses.
The collapse of Silicon Valley Bank.
Ceases to exist.
The second biggest bank collapse in U.S. history.
All in a matter of 48 hours. Introducing Silicon Valley Bank. But before we get into how such a large bank collapsed in such a short amount of time, we have to understand two things: what it takes for a bank to fail, and what occurs when a bank actually fails. For a bank to fail, it means that it was unable to meet its financial obligation. This could be for one of 6 reasons: insufficient capital, bad loans, liquidity issues, fraud or mismanagement, and economic shock. Now, if a bank happens to collapse for any of these reasons, it can have significant consequences for depositors, the economy, and society as a whole. Silicon Valley Bank was the 18th largest bank in the US and did business with 50% of all VC-backed startups. Their collapse was completely unexpected, and it even shows in their tweets that were mere days before their collapse. Things were actually going well. Silicon Valley's deposits almost tripled between the years 2019 and 2021. Now, the way that deposits work is that you, the person that uses the bank, cash in a deposit of, let's say, $10,000. The bank then forms an interest rate that depends on other variables. And so what the bank then does with your deposited money is they make loans out to other people. Silicon Valley had a massive influx of these deposits coming in, but the huge problem they had was that they didn't have the capacity to make loans at the same rate due to the rapid and sudden nature of the deposits. And this forced the Fed to cut interest rates. But as we said before, this money has to be put somewhere for the bank to make money. However, this is where Silicon Valley made the fatal mistake that initiated their downfall. So they decided to invest a little more than $80 billion in MBS, mortgage-backed securities, and 90% of these investments had a 10+ year duration. So essentially, SVB were locked in. Inflation ran wild, it reached an all-time high, so the Fed is forced to raise interest rates to attempt to slow down the velocity at which money is exchanged. And the reason why this is usually done to combat inflation is because higher interest rates makes loans more expensive for businesses and consumers, and everyone ends up spending more. And through this economic crisis, SVB had piled up a series of unrealized losses on its earlier investments. Whilst all this was happening, the companies SVB had invested in were also losing their value. And if things weren't already bad enough, the VC drought had begun. And this was especially bad for SVB because they did business with 50% of VC-backed companies. So they were forced to take major action. But to understand the actions that they took, we have to understand 2 key terms: insolvent and illiquid. Insolvent is when the bank can't pay debts because they don't have the money. Illiquid is when they can't pay the debts because the cash is invested somewhere else. And Silicon Valley at the time was illiquid. And as the rate at which deposits were outflowing increased because people were trying to get their money out, Silicon Valley were forced to sell 21 billion of their asset holdings to try and increase liquidity. And this caused a meltdown as people sensed the collapse. People were losing their cool all over the internet. Influential and well-known VCs publicly asked their firms to remove their funds from Silicon Valley. And unsurprisingly, this caused an uncontrollable chain reaction that spread like wildfire. A mere few hours later, investors and depositors initiated $42 billion of withdrawals in a single day. This shook the entire world as SVB stocks decreased by 70% in just 48 hours. But this disastrous collapse wasn't the end of it. The collapse caused a ripple effect that changed America, and this was for a number of reasons. Banks as large as SVB bear a lot of pressure due to the fact that they work with other multi-million-dollar companies. Some of these corporations had millions and some billions of dollars in their deposits. So you can imagine the severity of the situation when SVB collapsed, because what happens to all the money that people lost? Now, usually the government would intervene through the FDIC, which in the event of a bank failure ensures at least $250,000 per account. However, as we know before, Silicon Valley was no ordinary bank, and due to the sudden collapse, companies left millions of dollars in their accounts that they now couldn't access. So a mere $250,000 wasn't anywhere near enough to compensate the losses. This once again caused public outcry. The government has about 48 hours to fix a soon-to-be irreversible mistake by allowing SVB to fail without protecting all depositors. The world has woken up to what an uninsured deposit is, an unsecured illiquid claim on a failed bank. After the non-stop rage and pressure for something to happen, the government finally intervened. The US Department of Treasury finally announced that depositors will have access to their money, but not all was well. In addition to this major hiccup, another one of the immediate consequences of the collapse was a loss of funding for startups. Many early-stage companies rely on SVB to provide the money they need to grow their business. Without access to this funding, these startups would be forced to look elsewhere for financing, which especially after the collapse will be very difficult or impossible to secure. This will have an irreversible effect on innovation and entrepreneurships, as startups will be less able to pursue new ideas and develop new technologies. Some say that this will set them back by at least a decade. Now, considering the fact that this collapse was fairly recent, it's difficult for us to predict the full impacts on other areas of everyday life and business. But as this story comes to a close, many wonder, was this just a random hiccup, or is this the beginning of the end for other banks and the US economy? Only time will tell.